Margin trading is a method of trading assets using funds provided by a third party. Now, when compared to regular trading accounts, margin accounts allow traders to access greater sums of capital, allowing them to leverage their positions. Essentially, margin trading amplifies trading results so that traders are able to realize profits on successful trades. This ability to expand trading results makes margin trading especially popular in low volatility markets, particularly international Forex markets. Still, margin trading is also used in stock, commodity, and cryptocurrency markets. Now, in traditional markets, the borrowed funds are usually provided by an investment broker. In cryptocurrency trading, however, funds are often provided by other traders who earn interest based on market demand for margin funds. Although less common, some cryptocurrency exchanges also provide margin funds to their users. Now, how does trading margin work? So when a margin trade is initiated, the trader will be required to commit a percentage of the total order value. This initial investment is known as the margin, and it is closely related to the concept of leverage. In other words, margin trading accounts are used to create leverage trading, and the leverage describes the ratio of borrowed funds to the margin.
When an investor buys on margin, he or she pays a portion of the stock price, called the margin, and borrows the rest from a stockbroker. The purchased stocks then serve as collateral for the loan. Buying on margin requires a margin account with a broker, who then establishes the account's maintenance margin, which is the minimum amount of equity that must be maintained by the investor in a margin account. An initial investment of at least $2,000 is required for a margin account, though some brokerages require more. This initial deposit is known as the minimum margin. Once the account is opened and operational, you can borrow up to 50% of the purchase price of a stock. If the stock value drops below the maintenance margin, the investor must pay into the account to cover the difference. This is called a margin call. If the investor does not add money quickly enough, the broker can sell the stock without notice to cover the loan. When you sell the stock in a margin account, the proceeds go to your broker against the repayment of the loan, and any remaining profit is yours to keep. Say you want to purchase 100 Sunrise ZR stock with a price of $100, and your broker has a required initial margin of 50% and a maintenance margin of 20%. This means your broker requires you to initially pay $5,000 and maintain the account with a value of no less than 20% of the equity provided. If the Sunrise stock value drops below the 20% maintenance margin, the broker would issue a margin call.
For example, to open a $100,000 trade at a leverage of 10 to 1, a trader would need to commit $10,000 of their capital. Now, naturally, different trading platforms and markets offer a distinct set of rules and leverage rates. In the stock market, for example, a 2 to 1 is a typical ratio, while futures contracts are often traded at a 15 to 1 leverage. In regards to Forex brokerages, margin trades are frequently leveraged at a 50 to 1 ratio, but 100 to 1 and 200 to 1 are also used in some cases. Now, when it comes to crypto markets, the ratios are typically ranging from 2 to 1 to 100 to 1, and the trading community often uses the term X, so 1x, 2x, 3x, 5x, 10x, 50x, and so forth. Margin trading can be used to open both long and short positions. A long position reflects an assumption that the market will go up, or the price of the asset will go up, while a short position reflects the opposite. While the margin position is open, the trader's assets act as collateral for the borrowed funds. This is critical for traders to understand, as most brokerages reserve the right to force the sale of these assets in case the market moves against their position above or below a certain threshold. This is known as a liquidation price. For instance, if a trader opens a long leveraged position, they could be margin called when the price drops significantly. A margin call occurs when a trader is required to deposit more funds into their margin account in order to reach the minimum margin trading requirements. If the trader fails to do so, their holdings are automatically liquidated to cover their losses, and typically this occurs when the total value of all of the equities in a margin account, also known as the liquidation margin, drops below the total margin requirements of that particular exchange or broker.
A margin call is issued when the equity in a margin account falls below a certain level. In the United States, this level is set by the Federal Reserve Board Regulation T. Many brokerages have their own margin requirements, known as house requirements, usually with maintenance levels of 30 to 40%. For example, Joe buys 100 shares of Heisenberg Pharmaceuticals for $20,000, using $10,000 of equity and a $10,000 loan from the broker. After an extremely poor quarter, the market value of Joe's shares drops to $12,000, leaving the margin loan still sitting at $10,000, but the equity at $2,000. If the minimum maintenance margin requirement is 25%, then the equity must not fall below $3,000. In this case, the equity has fallen below the minimum maintenance margin requirement, and the investor would receive a margin call for $1,000. If this demand isn't met, the broker can close out any of his positions to bring the account up to the minimum maintenance amount. In most cases, the broker has the right to decide which securities and assets to sell and may be able to sell the selected assets without consulting the account holder. Thus, it is important to understand the risks associated with trading on margin, as borrowing money to leverage your investments can just as easily magnify your losses as it can with your gains.
Now, some advantages and disadvantages to trading with margin. So the most obvious advantage of trading with margin is the fact that it can result in larger profits due to the greater relative value of the trading position. Now, other than that, margin trading can be useful for diversification, as traders can open several positions with relatively small amounts of investment capital. Finally, having a margin account may make it easier for traders to open positions quickly without having to shift large sums of money into their accounts. Now, for all of its upsides, margin trading does have the obvious disadvantage of increasing and amplifying losses in the same way that it can increase gains. Unlike regular spot trading, margin trading introduces the possibility of losses that exceed a trader's initial investment and, as such, is considered a high-risk trading method. Depending on the amount of leverage involved in a trade, even a small drop in the market price may cause substantial losses for traders. And for this reason, it's important that investors who decide to utilize margin trading employ proper risk management strategies and make use of risk mitigation tools such as stop limit orders. Now, margin trading in the crypto market. Trading on margin is inherently riskier than regular trading, but when it comes to crypto, the risks are even higher. Owing to the high levels of volatility typical to these markets, cryptocurrency margin traders should be especially careful. Now, while hedging and risk management strategies may come in handy, margin trading is certainly not suitable for beginners. So it is highly recommended that moving forward, especially while you work your way through this course, you are trading via spot trading only. Now, spot trading is exactly what it says. You are trading without leverage, meaning you do not run the risk of liquidation should the price drop below a certain amount. Once we master spot trading, then we can consider moving into margin trading.